Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of today's video is how doctors avoid paying high taxes on their earnings. So income taxes are inevitable. There's no avoiding paying them. For higher income earners like doctors and paying more in income taxes that might also seem inevitable. But it does not have to be. There are a number of tactics physicians use to help lower their annual tax bills. Keep reading to learn their leverage retirement plans. Contributing to the retirement plan such as 401k or individual retirement account IRA help doctors as well as the other professionals save for the future. Retirement savings are a great benefit on their own, but these accounts can but these accounts can also be a valuable saving tax deduction. So talking about this, for example, 401k and 403b lets doctors save money at their high marginal tax rate with while also shielding their investments from taxes. When it comes time to start withdrawing those funds in retirement, then that income will fall in a lower tax bracket than when you were working. Meanwhile, the lifetime tax saving will like exceed your contributions. If you work another job, you could use a second 401k to help further lower your taxes. The way this would work: if you have a 401k with your employer where contributions come from your paychecks and potentially an employer match, you could then open an individual 401k from your side job and contribute up to 20% of your profit to the account. Additionally, a Roth IRA will lower your tax bill annually. Every dollar earned in this particular account isn't taxed as long as it withdrawn during your retirement. The same is true for the Roth 401k, Roth 403b, and Roth 457b accounts as well. While there are limits on how much you can earn while contributing to a Roth IRA, you can use the backdoor method if you have high income and still want the leverage. This retirement account, how to invest in a real estate. So the real estate ownership can also help doctors avoid paying high taxes in several ways. When you buy a house with a mortgage, you can claim a deduction on Schedule A, while only the interest of the first 7 lakh and $50,000 of debt. A new mortgage is deductible. It's still a large deduction for many doctors. Just keep in mind that property taxes and income taxes are combined and limited to $10,000 total as such as a schedule or deduction. Taking that deduction only works, however, if you itemize your tax bill. If you use the ever increasing standard deduction, you can't deduct mortgage interest. Having a mortgage is just one way that home ownership can help doctors avoid paying high taxes. However, you could also rent out your home to your business. Doing so for up to 14 days per year will allow you to avoid paying taxes on your rental income. The same applies if you rent out to others. Additionally, if you rent your home to pay your business, the rent paid becomes a business tax deduction. This deduction could be more than 10 to 20 times the size of a standard home office deduction. Meanwhile, the equity real estate investing can reduce the amount of the taxes you pay on the income the property produces. If said property depreciates, if you exchange the property instead of selling it, you could avoid recapturing the depreciation. There's also an opportunity to use real estate depreciation to offset to your or your spouse earned income. You'd have to qualify for real estate professional status. However, the entails working 750 hours annually in real estate and not surpassing that amount of time in anything else. Then the to hire help. If you have a young children who need to be looked after, any paid child care makes you eligible for the child and dependent care tax credits. The credit is up to 35% of $3,000 for one child under 12 years old and $6,000 for two child under 12 years of age spent on the child care. You can also apply this credit to summer day camps. The best part, it does not phase out like the child tax credits. Your children can also help your lower your taxes even after they are old enough that they don't require care. You can hire them when they are still minors as employees of your non-incorporated business. Their pay counts as business deductions, and your company and children don't have to pay payroll taxes on that income. Additionally, up to $15,000 can be earned prior to federal income tax becoming due. So, if we talk about donating money to the charity, giving money to the charity is usually rewarded with a lower tax bill. Itemizing deductions allows the any donations to appear on on your schedule A as a deduction. There are other ways to help others and benefit from a tax perspective uh, beside just writing a check. However, for example, if you donate appreciated mutual fund shares from one of your taxable accounts, you as well as the charity avoid paying capital tax gains. Plus, you'd still receive a Schedule A deduction for the donated shares whole value. Combining this strategy with tax loss harvesting could save high earning physicians plenty of money in taxes. Since the standard deduction has increased to $30,000 in 2025, in 2024 it was $29,200 for married doctors. Making smaller charitable donations may not be as beneficial from the tax lowering perspective. Instead, considering combining your charitable deductions and making a single bigger donation every other year, you can use the appreciated securities donation strategy to get big tax break this year and donate smaller amounts from that fund in the year after. So, the bottom line, taxes are a part of life for everyone who earns an income. High taxes are an even bigger part of the life for those who earn high salaries like physicians, but they don't have to be. Knowing the tools that are available to you and how to implement tax lowering strategies are key to minimizing your tax bill every year. The more you can save in taxes, the more you can put toward paying off medical school loans and saving for retirements and reaching all your other financial goals. So, more talking about this topic, what are the tax strategies for the physicians should know in 2025? So, the first strategy is maximize return contributions. Physicians often have access to multiple retirement accounts, and knowing how to allocate contributions effectively can significantly reduce taxable income. Contributing to tax advantage retirement accounts such as a 401k, 403b, or SEP, IRA. The self employed doctors allows you to defer taxes on your earnings. If you are employed by a hospital or a healthcare system, maximize your 401k or 403b contributions up to the annual limit of $23,000 in 2025 with an extra $7,500 if you are over 50. High income earners also take the advantage of the mega backdoor Roth IRA strategy if their employers allows after tax 401k contributions. The second is take advantage of an health saving account. If you have a high deductible health plan, you can contribute health saving account to an health saving account which can triple tax advantage. The first point is contribution are the tax deductible. Growth is tax free. Withdrawals for qualified medical expenses are tax free. Most physicians earn enough to pay for health care cost out of pocket. So instead of using your HSA funds immediately, consider investing them. Over time, this account can grow into an additional retirement fund for future medical expenses. The third point is leverage for qualified business income deductions. For doctors who own their own practice or work as independent contractor, the QBI deductions can be a game changer. It allows eligible taxpayers to deduct up to 20% of their qualified business income, but there are the income limits. If your earning exceed the threshold, tax professional can help implement strategies to lower taxable income and retain eligibility for this deduction. The fourth point is utilize tax efficient investing strategies. A strong investment portfolio is essential for long term financial success. So that was all about the topic. So hope this have been beneficial for you. Do subscribe the channel for more beneficial videos in future.